In 1982, Congress accidentally created a financial weapon so powerful that when regulators finally tried to ban it, they had to do it twice. The story doesn't begin on Wall Street. It begins with a question about what counts as a future. A future is a contract. You agree today to buy or sell something at a set price on a set date. Wheat futures, oil futures, currency futures, all tightly regulated by the Commodity Futures Trading Commission. But what happens when you try to write a future on a single stock? That's where everything breaks. Before 1982, the answer was simple. You couldn't. The Securities and Exchange Commission, the SEC, had explicit authority over stocks. The CFTC handled commodities and futures. That wall was intentional. It was designed after the 1920s crash to keep speculation on individual stocks contained. But in 1982, that wall developed a crack. Congress passed the National Futures Markets Commission Act. It was designed to clarify jurisdictions and modernize commodity trading, but buried inside was a clause that would reshape speculation for decades. It exempted certain contracts from CFTC oversight. The exemption was meant to be narrow. It wasn't. The wording was vague enough that a particular type of contract slipped through. That contract was the single stock future. Not quite a future in the traditional sense. Not quite a stock either. It was a hybrid, a contract to buy or sell shares of a specific company at a future date, but structured in a way that allowed sophisticated traders to argue it fell outside SEC jurisdiction. Here's the feedback loop. If it's not clearly under SEC control, who regulates it? For nearly 2 decades, the answer was almost nobody. Single stock futures existed in a regulatory gray zone. Traders could use them to take enormous leveraged positions on individual stocks without the transparency requirements that normal stock trading demanded. A hedge fund could accumulate an economic stake in a company that would have triggered disclosure requirements if done through normal channels, but through futures, it was invisible. Why did regulators miss this? Because it lived between jurisdictions. The SEC assumed the CFTC was watching. The CFTC assumed the SEC was watching. Neither agency had clear authority to regulate single stock futures, so neither did. This is what systems analysts call a gap, not an oversight, but a structural blindness baked into how 2 agencies divided power. The predictable outcome arrived in the late 1990s. As the internet boom accelerated, single stock futures became a tool of choice for momentum traders and speculators. Volume exploded, leverage multiplied, and then something interesting happened. People who understood the system started warning about it. Academics published papers. Regulators began internal discussions. One analyst after another pointed out the structural risk. The warnings were clear. Single stock futures allowed hidden accumulation of positions. They enabled market manipulation because the trades were hard to track. They created systemic risk because a sudden unwind could crater a stock faster than normal trading mechanisms could absorb, and they were completely legal. The loophole didn't just exist, it was defended by the people profiting from it. But here's where the story becomes instructive. The loophole didn't stay open forever. In 2000, the SEC and CFTC finally coordinated. They issued a joint order restricting single stock futures. And this is the critical part, the restriction wasn't a ban. It was a delay. They said no one could trade them until Congress explicitly authorized it. They were kicking the decision upstairs. Congress, feeling pressure from the financial industry, decided to authorize single stock futures after all. In 2000, they passed the Commodity Futures Modernization Act. The industry had won. Single stock futures were now explicitly legal. Exchanges began listing them. The gray zone had been formalized into law. The loophole didn't close, it became the official rule. What happened next is the punchline. Single stock futures never became the dominant trading instrument that speculators hoped. Why? Because by the time they were legalized, technology had evolved. Options, which were more flexible and more liquid, had become the preferred tool for the same strategies. The loophole was finally closed, but only because the market had moved on. The deeper lesson is systemic. A regulatory gap created by ambiguous language in a 1982 law persisted for nearly 2 decades because no single agency had both the authority and the incentive to close it. The people who predicted the problem, the academics, the careful regulators, were overruled by an industry with more political capital. The solution only arrived when the market itself rendered the loophole obsolete. So here's the answer to our opening question. Congress didn't create that weapon on purpose. It created it by accident, by writing a law with a loophole, by failing to coordinate between agencies, and by assuming that the financial industry wouldn't exploit ambiguity. Spoiler, it did, and when regulators finally tried to close the gap, the market had already evolved around it. This video is for educational and informational purposes only and is not financial advice. Always do your own research. If you're interested in how regulatory gaps shape markets or how the wealthy navigate the systems that govern finance, subscribe. There's a new story about the hidden architecture of wealth every week. Subscribe, there's a new story about the hidden architecture of wealth every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.